Welcome to Fly By Money. Derek here, where we talk about money, motivation, and entrepreneurship. This video is actually an idea given to me by my brother because he's getting ready to refinance. If you guys like content like this, please don't forget to like, comment, and subscribe to the channel for more content like this. We really appreciate it. I'll be adding some resources in the description below. And if you guys have any questions, please don't forget to put them in the comments. I'll be more than happy to answer them for you. So let's go ahead and get into this quick presentation that I have for you guys. So what we're going to talk about today is when and why you guys want to refinance your house and what are the most common reasons people do this. So let's go ahead and get into the subject matter. If you take a look here, the three common reasons that people refinance their house are cash out being number one for debt consolidation, paying off college expenses, paying off a car, buying a business, and a myriad of different reasons people will want cash out on their refinance. The second most common reason people refinance their house is people are looking to lower their interest rate, lower their payment, or change the terms of their agreement. For example, in our case, we actually refinanced our house to a shorter term to get the mortgage paid off sooner. So that's one of the things that people will do is they don't want to do a 30-year, they may only want to do a 15-year. So there's a lot of reasons why people do it for that number two reason. The number three reason is for divorce, for loan servicing issues, for a myriad of other issues where maybe they want to bring the loan locally, just the different reasons that people maybe they're selling a property that someone else is a part owner of. But there's just a lot of miscellaneous reasons like that. People will refinance to change ownership. So that's the third most common reason people typically refinance. So let's go into how do we know if we qualify for a refinance. So one of the things that I'm a big proponent of is before you go and get a car loan, before you refinance your mortgage, guys, you need to understand what you need to do that. And a knowledgeable consumer is going to get the best rates and terms, and you're going to save a lot of money and time and effort. Okay. And so the first things that you're going to need before you refinance is to know what your credit score is. A good credit score is going to be considered 700 or above. You're going to need to know what your loan to value is. A good loan to value for refinance from most banks is going to be considered 80 or 85%, okay, or less. One of the major reasons why 80% is a real stickler for a lot of banks and a lot of consumers is that if you owe more than 80% on your mortgage, the bank is going to require you guys to get PMI, private mortgage insurance. Okay, now private mortgage insurance is not mortgage insurance for the consumer, it is mortgage insurance for the bank. And you don't want to pay this because you literally get nothing out
So
of
you
this.
get
This is all for the bank
nothing.
if
You
you don't pay
lose.
your loan. So the lower the loan to value, the better the scenario is going to be for you guys, okay? The last piece of the puzzle is your debt to income. Okay, you want to have a good understanding of what your debt to income is. These are just the three most basic things that you guys need to know before you apply for a mortgage. And we're going to get into the reasons why this is important. But let's break down each of these a little bit more so you guys can kind of understand why they're important. Okay, so let's take a look at your credit score. A credit score of 700 or above is probably going to get you guys the best terms that a financial institution has. It's going to give you a lower rate. It's going to give you better terms. And what I mean by that is some banks are only going to give you a 5-year balloon and a 30-year mortgage, whereas if you have a higher score, they might give you a 30-year mortgage. It really just depends on the bank and on the institution or the mortgage company. But the better your credit score, the lower your rating, and the better your terms are going to be. So one of the things that you guys really need to do is go ahead and get with Equifax, Transunion, or Experian and get a copy of your credit report. This is going to save you guys a lot of time and effort. I actually use Experian to review my credit monthly. I probably look at my credit a minimum of 1 to 2 times a month. And basically, I'm just checking what my score is. I'm just checking to make sure there are no accounts that have opened that I don't know about. And it's just a great way for you to kind of keep up with your credit and know what's going on. This is going to make a crucial difference for you guys, because if you have something in your credit and you can fix this, this is going to save you the difference between 4% and 3%, which is thousands of dollars. Okay. The last thing I'm going to leave you guys with is I don't sign up for any of the subscriptions that they have. However, I do think it's something that you do want to look at. They have credit watch programs where if there's any alert to your credit, they notify you. And if you do have any credit fraud, it protects you in some way. I am in no way selling this to you guys, but I'm definitely telling you, at least look at it and see if it's something you're interested in. I don't participate in this because I look at my credit so frequently. I feel that I do have a little protection, but if I do see a good deal on it, I'm definitely going to go ahead and take that. Okay, guys? So let's talk a little bit about your loan to value. Loan to value is simply how much of your home do you own relative to the value of your house. Okay, so in this example, let's say your house is worth $200,000, and you owe $150,000 on your house between your first and second mortgage. If you have a second mortgage, that would put your loan to value at 75%. Okay, this is going to make a very easy refinance for the banks because your loan to value is below 80% or 85%, depending on the financial institution. And if you ask most banks, they will actually tell you this. Most of them will tell you their rough guidelines for approval. So don't be afraid to ask, guys. All right. So let's go ahead and talk a little bit about how would you know what your loan to value is, right? How would you know, right? How would you guys know what your loan to value is? One of the easiest things that you can do is to get the value of your home by asking your realtor. So if you guys ask your realtor, they will be more than willing to perform a real estate evaluation, a realtor's evaluation on your property. Some realtors will do this at no charge. Some will charge you a $75 to $100 fee. It really just depends on the realtor and how busy they are, if they want to do that or not. But I would definitely ask them because they may do it for you, considering that you may use them in the future. Basically, they do the same process that an appraiser does. They pull comps and they use a similar evaluation model to come up with the value of your house. Now, that's going to give you a pretty good value. If you can't do that, you can pull up your property's tax value by searching your county and looking up their GIS website. So put in the name of your county and then put in GIS, and you'll find your county's GIS website. You can then search your property's value looking by your name or your property address, and they will have a property tax value, which you probably receive a statement every year stating what your value is. Usually that value is fairly accurate. It could be different by your county, but it's definitely some sort of number that you can kind of base your value on, so you can know what your loan to value is before you approach your bank. The last place you can check is with Zillow or Realtor.com or any of these other websites. They do a pretty good job of estimating the value of your home, and they're using similar sale models by comparable houses that have sold close to yours, and then using your square footage and coming up with an estimation of your property's value. I do think they do a fair job. In our case, because our house was custom built and we bought the land and built the house, there isn't any information for them to really base it on. So they kind of have to use the tax value. There are no previous sales or anything like that. But they still do a fairly good job. I'm very happy with how accurate I've seen their models have been over the years. So that will give you your value. So let's go ahead and talk a little bit more about your debt to income. So your debt to income is essentially how much debt you have reported to your credit bureau. They're not going to be looking at your Time Warner cable. They're not going to be looking at your cell phone bill. They're not going to be looking at your how much coffee you buy, at Starbucks. What they're looking at, guys, is what reports to the credit bureau. So they're looking at your car loan, they're looking at your mortgage, they're looking at your personal loans, your credit cards, and then they're taking your gross annual income before taxes. Okay, so they're not looking at your income after taxes. They're looking at the gross number. So look at the gross number on your pay stub, and then you divide your monthly debt by your gross income to come up with your debt to income. So in this scenario, let's assume you have $3,000 a month between your car payment, your mortgage, and then you have $10,000 in your income. That would give you a 30% debt to income ratio. Okay, that's the way the math works on that. Now, most banks are looking to keep you at 35 to 40%. I have on here 36%. You can literally ask each institution, what's your debt to income requirement? And they really should give you this information. Okay. Now, this is something that a lot of consumers don't do. They just apply and they have no idea. You guys need to ask this question. I'm giving you guys some really good points here, some best practices. Please go ahead and like and subscribe for that. I really appreciate that. But for most cases, they're going to want you to be under 40%. The lower, the better, the lower the risk. Okay. Let's go ahead and talk a little bit about the questions you guys want to ask your financial institutions and why this is so important. So one of the reasons why I really think this is important is if you guys go ahead and apply and you don't know about your debt to income, you don't know your credit score requirements, you don't know any of these numbers, and then you find out later that this is their terms versus another institution's terms, you won't be able to apply to more than one or two before it starts affecting your credit score. Now, if it affects your credit score because you've applied to 3 or 4 different banks, what's going to happen is you're going to get worse terms. Your interest rate's going to be higher, your terms are going to be worse, your closing costs are going to be higher. Okay, so it's really important that before your application, you start talking to your bank and you say, hey, my credit score is this. I believe my debt to income is pretty close to this. What are the general terms that you have based on these criteria? They should have this information available to them. If they don't have this information, I'm going to ask you guys to go ahead and talk to other institutions that are willing to share this information with you. Now, I'm giving you the caveat that they're only basing it on what you're saying. Your credit score could come back different. Your debt to income could come back slightly different. But for my scenario, I really want you guys to be able to have a rough idea of what their terms are. So these are some of the questions that you guys want to ask. What are your interest rates? What are the terms that you offer? 15-year, 20-year, 30-year? Are there any balloons on the mortgage? So after 5 years, is the interest rate going to jack up on it? What are the closing costs involved? What are your loans held locally or are they sold? Like I told you guys before, we refinanced a few years ago simply for the servicing issues because our mortgage was being serviced in India and our communication level with them was terrible. Okay, and getting information about our escrow, and when we actually paid off the refinance the mortgage, the escrow actually kind of got screwed up for about 3 or 4 months. We had to pay the escrow out of pocket. It was a huge deal just because the loan servicing had been sold at least 4 or 5 times, and nobody knew what the other hand was doing. So I'm really a proponent of finding out whether your bank is selling your mortgage or not. Okay, here's a really good best practice and a really good point. If the financial institution tells you they sell 20, 30%, 50%, 1% of their mortgages, they're going to sell your mortgage. Okay, go ahead and give me a like, comment, and a subscribe for that because those are facts. If they say they sell any percentage of their mortgage, they're going to sell your mortgage. And that means your mortgage could end up anywhere. So last piece of the puzzle, I would definitely ask them, is there an appraisal necessary? So in our scenario, we actually did an equity line a few months ago. And when we did this, I always do it with my local credit union. And something said to me, hey, go ahead and check with another bank or two. And lo and behold, I found out that another bank was willing to do the refinance with no closing costs, no appraisal, based on my credit score, based on our credit score essentially. So that saved me probably $1,000 in closing costs, and they were able to close the loan within 3 days of the application. So this is huge. I know that my credit union would have taken at least a week or two, and this would have made a big difference in getting done what I wanted to get done. So if you guys have any additional questions about this on what you need to ask the banks, please feel free to put those in the comments below. I'll be more than happy to answer that for you. I really appreciate those comments. It's been really nice to see people kind of interacting, and I appreciate that. So the last piece of the puzzle is I wanted to give you guys some insight into, um, what does it look like to save on the interest rate? Like, what does that actually mean if my rate is 4% versus 5%? So in this scenario, we have someone that has a mortgage of $200,000 at 5% for 30 years. It's really simple. Their interest that they're going to pay over the 30 years is $186,000 essentially. If they have that same mortgage for 4%, 30 years, they're going to only pay $143,000 in interest. That's a difference of $43,000. That's a lot of money. If you were to compound $43,000 over the 30 years plus interest that you would make on that money, if you save that money as opposed to spend that money on your mortgage, it's a heck of a lot more money than $43,000. So as you guys can see, a difference of 1% based on whether that's your credit score or your loan to value. It's really crucial that you guys know that information up front before you apply, because once you applied and that's your credit score or that's your loan to value, that difference of 1% on your loan to value or 10 points in your credit bureau could mean $43,000 over the life of that loan. So you definitely want to know this information before you apply. Okay. So the last piece of the puzzle that I wanted to talk to you guys about was cash out and what that looks like. Okay. So in this scenario, we're saying that this person, let's assume a person purchased this house 10 years ago for $250,000 and now it's worth $300,000 through appreciation. Okay. So the house is appreciated over the 10 years from the price they paid of $250,000 to $300,000. And in today's market, that's definitely possible. So you currently, in this scenario, you currently owe $175,000. That means when you bought the house, you paid it down from $250,000 to $175,000. And then most banks will lend you 90% loan to value. Okay. Some are at 85%, but for the most part, most banks will lend you 90% if you have a good credit score. If you have good debt to income, they're going to lend you about 90%. So if you refinance at 90% and you assume the value of your house is $300,000, that's equal to $270,000. You subtract your current mortgage balance of $175,000, that would leave you with $95,000 in cash out. Okay, I just wanted you guys to have this example. It doesn't mean that when you refinance that you have to do cash out. You can only do $10,000 cash out, or you can max your cash out. Whatever you want to do, you can do it. If you guys have questions, like I said, don't forget to put them in the comments below. I'd be more than happy to answer those for you guys. So in the next part of the video here, I'm going to go over with you guys the amortization schedule. Okay, a lot of people are not familiar with this, but whenever you refinance, whenever you finance something, there should be an amortization schedule. On this schedule, you'll be able to see what percentage of your payment goes to principal versus interest with every payment that you guys make. Okay, here goes the example. So I wanted to give you guys an example of the breakdown that we did earlier and show you the amortization schedule. This will really help you guys understand like what percentage of your payment is going to principal and interest. So this is an easy calculation you can do on your phone. Most phones you can go to your shop and get a loan calculator, and that's basically what I did here. So I'm going to go ahead and let this play through, but this is based on a $200,000 loan at 5%, and it's going to show you the interest you pay. For example, your loan payment on this is $1,073. Total interest paid would be $186,000 over the 30 years at 5%. And the total amount of all payments would be $386,000. So let's take a look at how this breaks down between principal and interest. It actually will give us a fairly cool breakdown on a chart where the red is the interest it looks like about 43% is interest and 51% is principal, or actually 57%, I guess, is principal. So it also shows you a graph showing you what percentage of principal interest will be paid over time. And like I said, this is stuff that you guys really should want to go ahead and pull up on your own and kind of see what part of your payments go into principal and interest in the beginning. And what you'll see here is if you look on the amortization schedule, it'll actually show you from the very first payment what percentage goes to principal, what percentage goes to interest. And as you can see in the first few payments, quite a bit of those payments go to principal versus what goes to interest, and that's because the balance of the loan is higher in the beginning as it is in the end. But these numbers are really important for you guys to know, because this will really help you if you looked at a 30-year or whether you looked at a 20-year or 15-year. So ask for an amortization schedule based on the loan amount that you're looking at. This will really help you guys make those key decisions that you need to make. Thank you guys for tuning in to another video where we talked a little bit today about refinancing your house and some of the basics that you guys need to be able to do that. If you have any questions, please feel free to leave those in the comments below. I want you guys to be as knowledgeable a consumer as possible so you guys can get the best rates and terms that the banks have out there for you. Thank you guys for watching. Don't forget to subscribe. Have a great day.